Consolidation procedures at the date of acquisition are simple in the sense that only the statement of financial position of the combining constituents are consolidated, and this involves the following steps. First is to eliminate the investment in subsidiary account. We have to eliminate the investment in subsidiary account to ensure that there are no overstatement, and this requires measuring the identifiable assets acquired and liabilities assumed at their acquisition date fair values. Next is recognizing the goodwill from the business combination. Next is eliminating the subsidiaries pre-combination equity accounts and replacing them with non-controlling interest. So we have to eliminate the pre-combination subsidiaries equity accounts since this equity are no longer belongs to the subsidiary and it already controlled by or owned by the parent. Second is to add line by line similar items of asset liabilities of the combining constituents. Next slide, please. Consolidation subsequent to acquisition date. The consolidation procedures subsequent to the acquisition date involve the same procedures as consolidation at acquisition date, but changes in subsidiaries' net assets since the acquisition date are considered. Next slide, please. So to further understand, we have an illustration for consolidation at acquisition date. The financial statement of a parent and its subsidiaries at the acquisition date are shown below. So we have cash of the parent, 10,000, accounts receivable of the parent, 30,000, inventory of 40,000, investment in subsidiary of 75,000, equipment, a net is 180,000, a total of 335,000, accounts payable of 50,000, share capital of 170,000, share premium of 65,000, retained earnings of 50,000, and the total liabilities and equity of 335,000. For the subsidiary, we have cash of 5,000, accounts receivable of 12,000, inventory of 23,000, equipment net 40,000, a total assets of 80,000, accounts payable of 6,000, share capital of 50,000, and retained earnings of 24,000, a total liabilities and equity of 80,000. Next slide, please. Additional information. The subsidiaries' assets and liabilities are stated at their acquisition date fair values except for the following. Inventory is 31,000 and equipment net of 48,000. The goodwill determined under PFRS 3 is 3,000. The NCI in the net assets of the subsidiary is 18,000. Next slide, please. Requirement 2. We have to prepare the consolidated statement of financial position. First step is to eliminate the investment in subsidiary account. That is 75,000, and which also requires the measurement of the subsidiaries' assets and liabilities at acquisition date fair value. The inventory is 31,000 and the equipment is 48,000. We also have to recognize the goodwill, that is 3,000. And we also have to replace the equity of the subsidiary with the NCI in the net assets of 18,000. Next slide, please. So for the consolidated statement of financial position, we have the cash of the parent of 10,000, accounts receivable 30,000, inventory 40,000, investment in subsidiary none since it was eliminated, equipment 180,000, goodwill no, 0. Accounts payable is 50,000, share capital 170,000, share premium of 65,000, retained earnings of 50,000. Then for the subsidiaries, we have 5,000, and the total consolidated cash is 15,000. Accounts receivable consolidated, we have 42,000, inventory 71,000, investment in subsidiary none, equipment is a total consolidated equipment of 228,000, goodwill of 3,000, a total assets of 359,000. We have consolidated accounts payable of 56,000, share capital of 170,000, share premium of 65,000, retained earnings of 50,000, and NCI net assets of 18,000, and a total of 359,000 liabilities and equity. Before I forget, if we are going to journalize the elimination, we will debit common stock 50,000, retained earnings 24,000, equipment 8,000, inventory 8,000, goodwill 3,000, and credit to investment in subsidiaries of 75,000 and non-controlling interest of 18,000. That would be all for our report. Thank you.